Hi guys, what's going on? Welcome to my channel. My name is Avery Lewis and I'm finally here to start my financial journey on YouTube. I've been putting off starting this channel for a number of reasons, but mainly because I just don't know if it will gain the traction I hoped it will for the amount of time that I'm willing to put into this. Anyways, just to help out with starting the new channel, I'd appreciate if you'd smash that like button for me right at the beginning so you can just enjoy the rest of your video. Anyways guys, I'm going to talk about what we're going to get into on this channel. So we're going to be getting into the stock market basics like I'm about to get into, but we're also going to be getting into ways to make money as a teen and ways to invest your money responsibly and just other minute things that you might not think about but can actually help you as you get into your later 20s or early 20s even, depending on how old you are. Anyways, I'll continue introducing myself in future videos and introducing what's more to come on the channel. But right now, let's get into today's video. Mutual funds versus ETFs. I know the name of this video is actually pretty long and might be a lot to take in, but we'll go over each part of it and why it's so important. I was recently watching a video from a channel, Our Rich Journey, here on YouTube, and one fact stuck out to me and inspired this whole entire video. It was only in 1975 when ETFs were brought onto the financial scene by the Vanguard founder, Jack Vogel. And as we all know, I don't know each of your financial education individually, but I will explain ETFs briefly and then get into why I made this video. Because this channel is named Simply Finance, this is the only place where you'll find the most simple way to learn about pretty complicated things in the stock market. So put simply, ETFs are just a certain portfolio and collection of stocks that track a certain market index. Let's say you think technology will have an amazing year or amazing next 5 years. If you want to invest in this sector, but you're not quite sure you want to put all your marbles into one basket, you can look into a technology ETF. My favorite one is ticker symbol XLK. By investing into XLK, you can invest in Apple, Facebook, and Microsoft and a ton of other technology companies for just over $100 per share. This helps to mitigate risk and save the stress of investing in one or a few stocks by investing in hundreds of stocks. The main reason I love ETFs is because I know I want to invest in all technology stocks, but I don't have the tens of thousands of dollars that it would take to invest in all these companies individually. Let me simplify this for you. Let's say you take $1 of 100 different companies of their share price and you put it all into one stock and you sell that for $100. This is the best way to diversify your portfolio and make it less volatile to market conditions. Like I said earlier, most retail and new investors don't dabble with tens of thousands of dollars because they just simply don't have that much to start, or they don't want to invest all that into one sector. And that is where we dive into the meat of this video. Mutual fund managers. These guys, prior to 1975 and the invention of the ETF, were the only way to diversify your portfolio in the way that the modern ETF does. This was the only way to get so-called fractional shares in a company. They were able to do this by making their own collections because they owned so many different stocks, and you could just select what collection you wanted to invest in and they would invest it for you. However, this came with larger fees than what ETFs do today. This is largely because mutual fund managers actually manage the money that's in their account. This is different from ETFs because ETFs are what's called passively managed, and they don't actually get managed like every day by a normal person. They simply track a market index, but we'll get into why this is actually better than paying a mutual fund manager. While you would think an active portfolio that's being managed would outperform the market, recent studies have actually shown that this is the opposite of the case. In the past 15 years, less than 10% of mutual funds have actually outperformed the broad market. This has inspired many people to just invest the money themselves in apps like Robinhood and Webull because the costs in those apps are so much less than paying a mutual fund manager. The reason that these mutual fund managers advise against ETFs is only because every person that invests in an ETF is not paying them. When ETFs came on the scene in 1975, the mutual fund managers kind of just ignored them and acted like they didn't exist because they didn't want to believe. They just hope for the best, that ETFs would be ignored by the mass populations and that they would just continue doing their thing. As more millennials and whatever was born in the 2000s are called started investing, mutual fund managers have just been losing exponential amounts of new clients because we have decided that we'd rather invest ourselves. Whether betting on Robinhood options or just investing in a Vanguard Roth IRA, like I've done both, it's still very fun to invest your own money and see real returns. Robinhood and Webull have taken these mutual fund managers' clients and they're not too happy about it. I believe the reason that we're more inclined to use apps like Robinhood is simply because of the aesthetics of the app and the real-time winnings, whereas you don't have to wait as long to realize your winnings with a mutual fund manager. The desire for immediate gratification is just uncanny. It's just more satisfying to see all the green positive results in an app, meaning that you've actually made real money, than just hearing some reports from old guys about the money that they've invested on your behalf. I also believe that seeing either a green or a red has a lot of implications for our minds. Seeing a green helps us with our self-confidence, and seeing a red only provides determination to one day see a green day. Our brains are so stimulated every day that seeing this red and green is the only way to keep us interested in our money and our finances. This is a big reason why I believe mutual funds are losing customers. And also, another reason is that these mutual funds take so much money. The only people that I would even suggest using a mutual fund is people with so much money that they need the security of somebody watching over it 24/7. This is one advantage I believe mutual funds still have, is that they can have one-on-one conversations with their clients and go over exactly what strategy they're using with that person's money. However, there is just no reason why anyone with less than probably $100,000 should even look into these mutual funds or a money manager. Just think about it. Why would you pay somebody if the odds of them losing compared to the broad market is 90%? One answer is that some mutual funds do have a proven history of outperforming the market, but this usually comes with even higher fees than normal. The more that a mutual fund can prove their promise of outperforming the market, the higher their premiums will be, which could potentially offset any extra earnings that they will provide you, or even maybe lose you money compared to the broader market. I do have to tell y'all that I do prefer investing into ETFs myself because of the small fees, just to keep the ETFs in check, and I don't like to pay expense ratios when I don't have to. There's never a totally free way to invest in ETFs or mutual funds, but ETFs typically only require less than 0.1% of your investment per year to sustain the fund itself. This is such a small amount, especially compared to mutual funds, which typically could require over 1% of your investments annually. So just to put this in simple form, if you have $100,000 to invest in 1 year, I'll go over how much each fund will take from your investments per year to manage it. On the $100,000, a mutual fund might take $1,000 in the first year that you invest it, while an ETF may take about $100 per year. This may not seem like that big of a difference, but you have to take into account the exponential compounding returns, which I'll get into right now. So if you make the standard 10% return, not including inflation, the first year, the next year you'll have $110,000 to invest. This would come out to $1,100 taken by the mutual fund the next year, a $100 increase in fees from the previous year. However, with an ETF, your fee will only raise $10 in a full year. This means that the difference in the fees that you'll pay to the two funds increases almost $100 in difference in the first year. As your investment portfolio value increases, the fees will only continue to grow further and further apart, with the mutual fund taking exponentially more than the ETF would cost. In the end, even if you invest into one of the 10% outperforming mutual funds, in the end, your money won't even go as far as if you just had invested in ETFs in the first place. Any returns you make using the mutual fund that outweigh an ETF will just be outweighed by the fees. And this is why Jack Vogel had a vision and why ETFs are indeed better to invest in than mutual funds. Mutual funds have just become outdated and less useful than ETFs. And the only reason why I would ever suggest using a mutual fund is if you are so wealthy that you just can't handle the money yourself and you don't trust any brokerage other than a mutual fund. However, I may have made it sound like other brokerages such as Robinhood and Webull don't offer security. They're very secure, but I'm just talking about the one-on-one client experience that would come with a money manager. My only suggestion, like I already just restated, but I just wanted to restate one more time, is only use a mutual fund if you can spend some money and you don't mind spending some money for someone to monitor your investments 24/7. Basically, only consider mutual funds if you have more money than you can spend. Not really, but there's not really any other realistic reason why you would use a mutual fund. In conclusion, not to alarm any mutual fund investors in case I did, this video is just for entertainment purposes only. Well, anyways, guys, I hope y'all learned something valuable from this video, and I hope that you stay tuned and maybe even subscribe down below if you find value in this channel. Thanks, and stick around for my next video. Peace.